Okay, this video is really going to talk about some solutions to problems from Chapter 9, which is reporting and analyzing long-lived assets. I have loaded onto Sakai the questions and the solutions so that you can take a look at them. And as I always suggest with these practice problems, is that you try the problems before you watch the video. So get something down on paper, take a look at your solution, watch the video, and then see where you went wrong. So the first one we want to take a look at is exercise number 2. And exercise 9-2 is just a series of questions. It's not really a problem. But so it says, exercise 9-2, Adama Company incurred the following costs. So there's a list of 9 types of costs and disbursements. And the instructions say, indicate to which account Adama would debit each of the costs. So this is really looking at what type of expenditure this is. Is it a capital expenditure? Is it an expense expenditure? And if it is a capital expenditure, long-lived asset, which account specifically? So the first one is sales tax on factory machinery purchased. So this is the sales tax on the factory equipment, and this is part of the equipment. So this is one of those costs that are associated with getting an asset ready for its intended purpose, and all related expenditures should be capitalized along with it. So it goes to the equipment account. The second item is painting of and lettering on truck immediately upon purchase. So they just purchased this truck and they're putting some corporate lettering on it. Again, this is getting the asset ready for its intended use. It goes to the equipment account. Number 3, installation and testing of factory equipment. So they're getting this asset ready to use, so they're installing it and testing it. They're not using it to produce product yet, so this is part of the equipment account, the long-lived capital asset. Number 4, real estate brokers commission on land purchase. Again, this is a cost associated with getting the land ready for its intended use. It goes to the land account. Number 5, insurance premium paid for the first year's insurance on the new truck. That's going to go to the prepaid insurance account. That's an asset account, and then you're going to expense that monthly with an adjusting journal entry. Number 6, cost of landscaping on property purchased. So these are trees and shrubbery and plantings. So this is not part of land. This is part of land improvements. Number 7, cost of paving a parking lot for the new building constructed. So this is paving, this is asphalt. This is also a land improvement that will be depreciated. Number 8, cost of clearing, draining, and filling the land. Again, this is a cost associated with getting the land ready for its intended use. It goes to the land account. And lastly, number 9, architect fees on self-constructed building. So these are fees associated with designing the building. This is going to be capitalized as part of the building account. It goes to building. Let's look at exercise 3. And it says here, 9.3, on March 1st, 2022, Boyd Company acquired real estate on which it planned to construct a small office building by paying $80,000 in cash. An old warehouse on the property was demolished at a cost of $8,200. The salvage value materials was sold. They received something, $1,700. Additional expenditures before construction began included $1,900 for attorney's fees for work concerning the land purchase, $5,200 real estate broker's fee, again for the land, $9,100 architect's fee, and $14,000 to put in driveways and parking lot. So the question is, determine the amount to be reported as the cost of land. So we have the cash purchase for $80,000. We have the removing the warehouse that was on the land for $8,200. But they received some salvage value of $1,700, so that's going to reduce the cost. They had the attorney's fee to purchase the land. That was for $1,900. And then they had the real estate broker who helped with the purchase of the land. The land account should be a total of $93,600. It goes on to say, for each of the costs not used, indicate the account to be debited. So the ones that we did not use were the architect's fee for $9,100. The architect's fee was used to design the building, so that goes into the building account. And lastly, the cost of the driveways and parking lot for $14,000, that should be debited to the land improvements account. Let's now look at exercise 5. And exercise 5 says, Gotham Company purchased a new machine on October 1, 2022. Be careful of your dates. October 1, 2022, at a cost of $90,000. The company estimated that the machine has a salvage value of $8,100. The machine is expected to be used for 70,000 working hours during its 10-year life. So it says compute depreciation expense under the straight line method for 2022, the year of acquisition. Mind you, it was only in service for October, November, and December. And then 2023 for a full year, assuming a December 31st year end. So let's first calculate depreciation expense using straight line. So straight line, right, equals cost minus salvage value divided by useful life. So in our case, we're looking at $90,000 cost minus $8,100 salvage value. It's a 10-year life. So per year, it's going to be $8,190. 2022, it was only in service for 3 months, October, November, and December. So that's going to be 3/12, 3 months out of the 12, times $8,190. The depreciation expense is $2,048. And then 2023, that's the full year for $8,190. So, like I said, be careful of the dates. This is exercise number 7. Victor Minelli, a new controller of Santorini Company, has reviewed the expected useful lives of salvage values of selected depreciable assets at the beginning of 2022, at the beginning of the year, January 1, 2022. Here are his findings. And there's a chart of information there. All assets are depreciated by a straight line method. Santorini uses a calendar year in preparing annual financial statements. After discussion, management has agreed to accept Victor's proposed changes. A, compute the revised annual depreciation on each asset. So we have, remember, depreciation is an estimate. And we have some revised information. The estimates have changed. So we need to change the amount of depreciation expense. So we have here the building. And then we have the warehouse. So remember, we need to calculate the book value and then subtract the new salvage value divided by the remaining number of years. So the original cost of the building was $700,000, and they have accumulated depreciation to date of $130,000. So the book value is $570,000. the remaining life, I'm sorry, we got to subtract the salvage value. The new salvage value is $35,000. So they're going to depreciate $535,000 over. So that's the book value minus the new salvage value. We got to divide that over the remaining number of years. So when the problem, it said that they had the new useful life was 58 years, and they've already gone 8 years on that. What are the 8 years? Well, the 8 years, it was put in service, acquired in January 1, 2014. So 14, 15, 16, 17, 18, 19, 20. This goes in service when? 2022. So they have gone a total of 8 years, haven't they? They've gone 8 years already. Years to date, 8 years. Because it was what? 14, 15, 16, 17, 18, 19, 20, 21. It's 8 years. So they've got 50 more years to go. The annual depreciation, $10,700 per year. The warehouse had an original cost of $120,000. They had taken accumulated depreciation of $23,000. The book value is $97,000. The revised salvage value is $3,600. And again, we're subtracting that. $93,400 is the new depreciable cost. And we need to divide it by the remaining number of years, which is going to be 15. So let's look at it. They have a new useful life of 20 years, but they've already come 5 years. Well, how did they get to 5 years? It was put in service in 2017. So 17, 18, 19, 20, 21, 5 full years. So we have 15 years here. The annual depreciation is now $62,227. And when you record depreciation, when you make this change, this is done for the current year and go forward only. Let's look at the next problem. That was number 7. Let's look at number 9. Company has delivery equipment that costs $50,000 and has been depreciated $24,000. Record entries for the disposal under the following scenarios. So we have a book value that's equal to $26,000 because the cost was 50 minus accumulated depreciation 24, book value of 26. So we have 3 scenarios. It says, first of all, it was scrapped as having no value. So what you want to do is record the cash, remove accumulated depreciation, remove the asset, record gain or loss. But in this first scenario, it was scrapped. There was no cash received. So they're going to remove the accumulated depreciation with a debit and a credit. Remove the accumulated depreciation for $24,000. We're going to remove the equipment for $50,000. And remember, our debits have to equal our credits, so we're going to have a loss on disposal of $26,000. The order of your debits and credits really don't make a difference, but as long as they equal 50 and 50. The second scenario is where they sell that asset for $37,000 cash. So receive the cash of $37,000, remove the accumulated depreciation with a debit, $24,000, remove the equipment with a credit for $50,000, and in order to make my accounts balance, and I have a gain on sale of 11. debits have to equal your credits. And then lastly, they have a situation where they sell it now for $20,000. The cash received is 20. Remove the accumulated depreciation again for the 24. Remove the equipment for 50, and now you have a loss, a debit on sale of $6,000, right? 20, 44, 50, and 50. Debits equal your credits. So those are the problems for this chapter. Thank you.